All right, let's talk about TriplePoint Venture Growth, ticker TPVG. Their latest earnings report just dropped, and boy, it was a doozy. We're talking a dividend cut, a big stock drop, but at the same time, management is painting this picture of incredible future growth. So what's really going on here? Let's dig in and figure out what happened, and more importantly, what could happen next.
So, the very next day after they reported earnings, bam, the stock gets hammered, down a whopping 8.3%. You know, a drop like that doesn't just happen. Something in that report really spooked the market. So the big question is, why? What exactly was in there? Let's dive into the numbers to tell the real story.
Okay, so let's get into it. It really all starts with the numbers, and to put it bluntly, it was a miss. The company just didn't hit the targets that Wall Street had penciled in.
Okay, let's break this down. The big number everyone watches for a company like this is net investment income per share, or NII. It's basically their core profit metric. Well, they reported 28 cents, but the street was looking for almost 30 cents. That's a miss of about 5.5%. And it wasn't just NII. Revenue fell short too. You know, when you miss on both the top and bottom line like that, it's going to set a negative tone right out of the gate.
But you know what? The earnings miss, that wasn't even the headline. The real bombshell was the dividend. Management came out and said they were cutting it, and not by a little bit. They're taking it from 30 cents a share all the way down to 23 cents. Now, you have to remember, for an income stock like a BDC, the dividend is everything. So a cut like this, that's a huge deal. And honestly, it was the main reason the stock got hit so hard.
So if we look past the headlines and kind of peek under the hood at the actual portfolio, what do we see? Well, it's a bit of a mixed bag, really. On the plus side, their net asset value, think of it as the company's book value, was actually pretty stable. That's good. But the credit quality took a little bit of a hit. They had to move one company to non-accrual status, which is just a fancy way of saying they're not collecting interest on that loan anymore. So the main takeaway here is, yeah, the value is stable, but we're starting to see a few little cracks appear in the credit side of things.
Now, you'd think with all that bad news, management would be on the defensive, right? Well, not exactly. They barely spent any time talking about the quarter that just happened. Instead, they wanted to tell a completely different story, a growth story. They framed this whole thing as a strategic pivot, a painful but necessary step to set themselves up for the future.
And this quote from the CEO, Jim Lieb, really says it all. Our sights are set on setting the stage now for the future. What he's basically saying is, hey, forget about this quarter. Look at what we're building for tomorrow. It's a classic jam tomorrow story, asking investors for patience.
So what's the actual bull case they're trying to sell? Well, they pointed to a few things. First, they actually funded almost $79 million in new deals. That's their best quarter in over 2 years. They're also making a big strategic push into hot sectors like AI and enterprise software. And then there's the secret weapon, their portfolio of 106 warrants, which includes stakes in some huge pre-IPO names like Revolut and Cohesity. This is their whole argument. Yeah, the present is tough, but just look at all this potential upside we're building.
Okay, but this brings us to the million-dollar question, right? It's the one that separates what management is saying from what the market is feeling. If this investment pipeline is so amazing and they're funding all these new deals, then where's the growth? Why isn't the portfolio getting bigger? And here's their answer. They're saying that their successful companies are actually paying back their loans early. Now, on one hand, that's a good sign. It means their portfolio is healthy. But on the other hand, it creates this massive headwind. It's like they're pouring new money in one side, but it's leaking out the other side just as fast. They're basically admitting this is going to keep happening, and we probably won't see any real portfolio growth until sometime in 2026. So, to prove they're serious about this long-term plan and to put their money where their mouth is, the company's sponsor and advisor stepped up. They announced a couple of really big moves to show shareholders they're all in this together.
So here's what they're doing. First, the advisor is waiving all of its performance fees for the rest of 2025. That's a huge deal. It's basically a direct cash infusion into the company's bottom line, which helps make sure they can actually cover that new lower dividend. And second, the main sponsor, TriplePoint Capital, is going to buy up to $14 million worth of stock in the open market. That's a classic move to support the stock price and send a clear signal that they think it's cheap.
Okay, so we've got the earnings miss, the dividend cut, management's jam tomorrow story, and the sponsors stepping in to help out. Let's put it all together and ask, what happens next? Here at Talk Tickers, this is our official take on the next quarter. All right, here's our 90-day outlook. We see net investment income landing somewhere between 24 and 26 cents. Those few waivers are going to provide a really nice floor, but the loan prepayments are still going to be a drag on growth.
For the stock price, we think it's going to be pretty range-bound. All the bad news is out, it's priced in, and that buyback program should put a floor under the price. So that leads us to our rating, market perform. Look, the whole story here boils down to one word, execution. If they actually deliver on this pivot to AI, there's absolutely upside. But for now, it is 100% a show-me story.
Okay, and before we wrap up, it's time for my favorite part, the outrageous but plausible trade idea. This is the kind of thing you might overhear two hedge fund managers talking about at lunch. It's a little out there, but it just might work.
Here's the play. It's a pair trade. So on one side, you go long TPVG. But here's the key. You're not buying it for the loans or the dividend. You're buying it for that warrant portfolio we talked about. You're making a very specific bet that one of those companies, like a Revolut, has a surprise IPO or gets bought out, which would cause TPVG's book value to explode higher overnight. Now, to protect yourself, on the other side of the trade, you short the BDC sector ETF. That's ticker BIZD. What that does is it hedges out all the boring sector-wide risks, things like interest rates and general credit worries. It basically isolates your bet, so you're only exposed to that one huge company-specific catalyst in TPVG's back pocket.
And of course, we have to say it, this is for informational purposes only. It is not financial advice.